We're seeing another sharp sell-off today after markets bounced back yesterday. The seesaw, of course, reflecting and creating a lot of uncertainty. Investors trying to navigate risk management here. For more, we're bringing in Michael Darda, chief economist and macro strategist at Roth Capital Partners. Always great to see you. So it feels like with this whipsawing back and forth, obviously the coast is not clear. Does the name of the game here does it become minimizing the damage, managing one's risk? Is that what investors should be prioritizing here?
Absolutely. So whipsaw is definitely the right word for this. Financial markets are being whipsawed, and that's due to public policy being chaotic and also being whipsawed from one day to the next. So I think for investors, it's a matter of staying calm, staying diversified, looking at opportunities with these dislocations. But keep in mind, I think this is a process that's going to unfold over time. No one's going to pick the bottom. There's a lack of visibility now in terms of forecasting earnings. We talked about that the last time I was on, and your previous discussion about recession risk. I mean, obviously those risks have ramped up. And the market is telling you the same thing.
What is your outlook, Mike, for the economy in 2025, and how would you, sort of rank your recession odds?
Yeah, I think it's a 50-50 shot at this point in terms of recession hitting this year. That's quite high. In a typical environment, it's probably 10-15%. So that is elevated. And it's a shame because it looked like the Federal Reserve essentially had this soft landing in the bag in this huge tariff disruption, which is not over, has really thrown a monkey wrench into the soft landing. It puts the Fed in a terrible position where now they have to worry about downside risks to growth. At the same time, there are short-term upside risks to inflation. So if the Fed is sort of paralyzed here and the economy's weakening, that really does increase the risks of a downturn. And you can see that in various credit market indicators. High yield debt spreads have widened very sharply from quite narrow levels on a historical basis, but that's one of several things that you tend to see coming into a weaker growth period with higher risks of a downturn.
Mike, I was intrigued by a note you put out a couple of days ago where you talked about places that you were starting to see opportunity. Now, in this fast-changing market, I don't know if all of these still hold, but I want to ask you about them anyway. One of them was JETS, which is an ETF that tracks the airlines. We heard from Delta yesterday, which sort of pulled its forecast, part of its forecast, kept part of its forecast. So the markets were reassured by that even before the overall market increase. But do you still think airlines are a good place to nibble at here?
Well, I think it really depends on the risk tolerance of the investor. But we were talking about areas that have just been crushed coming into the session before yesterday. Airlines, tech, energy, these are all down sharply again today. So I think it's important to keep in mind if you're leaning into these dislocations, the dislocation is there because of bad news, but the market's discount in real time. So if you're leaning against the wind a bit, I think that makes some sense. This huge reversal that we saw yesterday, then I think you want to step back a little bit. And now, we've given a big chunk of it back. So as I mentioned before, I think this is a process now in terms of this correction, potential bear market. No one's going to be able to time it. Typically with a recession, S&P 500 falls just over 30%. We were down at the lows earlier this week about 19%. So I kind of think of that as you're 60% to 2/3 of the way through a recessionary adjustment. And so I think it makes sense to put a toe in the water and absorb a bit more risk for longer term investors that do have the tolerance to be in the market and to ride out the storm. But that is in no means an effort to say, this is the bottom or we've bottomed. I think those highs that we saw earlier in the year, probably aren't going to be back in focus for some time.
Mike, earlier in the show, I asked another strategist this, but I want to get your take too, because you are both a strategist and an economist. I am curious to get your take on what we are seeing with the dollar, Mike, and the continued weakness there, what you make of it, and what you think the ripple effects, the implications we need to think about from that.
Yeah, great question there. I mean, it's actually quite confusing because you have the dollar tanking. So normally people would think of that as inflationary. You have bond yields at the long end of the yield curve surging. People would normally also think of that as inflationary. But bond market inflation expectations have also cratered. So this move up in yields has been driven by real rates, and the dollar move, which has also come as a surprise, is not filtering into bond market inflation expectations. So I'm actually a bit more worried about recession than inflation. Yes, the tariffs are going to raise inflation in a temporary way, but that will not be sustained over time if the economy hits the skids. And I think that's what the inflation break-even market is telling you. We also could have a situation here, I phrased it this way for a client: if you're not going to buy our goods, we're not going to be able to buy your bonds. And so you could have a bit of a reversal in some of these capital flows going on as a consequence of the trade war. And we need to be careful what we wish for, because the last time the US ran a current account surplus was during the 1990-91 recession. So if you torpedo the economy and tank investment relative to savings, then the current account deficit can fall. But is that really what you're trying to accomplish?
Mike, always great to see you, my friend. Always great to have you on the show. Thank you for joining us.
Thank you.